In this video, we're going to talk about how to use the equity method to account for investments. So when you own between 20 and 50% of a company's stock, you're deemed to have significant influence. And so what significant influence means is that you could alter a firm's dividend policy, right? Because you own so much. Let's say, for example, you own 40% of a company. You could influence whether or not they issue a dividend in a given period. And the reason that this is important is because even though that firm you've invested in might be incurring losses, you could pressure them. You could use this influence that you have to get them to issue a dividend. And if we were accounting for things under the fair value method, when you own less than 20% of the firm's shares, you would be recognizing income with that dividend. You would have dividend revenue. So it would look like you were generating revenue from this investment even when the investment is losing money. So to prevent firms from playing this game, we've basically developed the equity method, in which what's going to happen here is you're going to recognize a proportionate share of net income or the net loss that the investee has. So for example, if you've invested, you own 40% of that firm's shares, and then that firm has a loss, you will have to book 40% of that loss. Or if they have net income, you get 40% of that net income. And you don't recognize any dividend revenue. You just recognize a proportionate share of their earnings or their losses. So let's walk through an example and make it a little easier to understand. So let's say that we've got Tom's Surf Shop. You're interested in investing in them, and they have 250 shares of stock outstanding. So you decide, you know what, I think I really like this business. I want to buy 100 shares. I want to buy 100 shares of Tom's Surf Shop. And if you do the math, 100 divided by 250, that's going to be 0.4. So this is 40%. 100 shares is 40% of the company. And so that cost you $175,000. So now we need to make a journal entry. So what we're going to do is we're going to debit the investment in Tom's Surf Shop. Just call it investment or whatever you'd like to call it. And we will debit that for $175,000. Now, we're just going to assume you pay cash, so we're going to have a credit here for cash of $175,000. And this is just to reflect the purchase of 40% of Tom's Surf Shop. Now, we're going to have some action here. So let's say that Tom, his surf shop reports net income of $32,000. So they made $32,000, and so now you're going to need to make a journal entry here. So remember, we're going to recognize the proportionate share of net income or a net loss. We're going to recognize that. So we see we've got $32,000, but we're not going to recognize the whole $32,000. We're going to recognize 40% of that. And $32,000 times 40% is $12,800. So what we're going to do is we're going to recognize investment revenue. We're going to have a credit here of $12,800. Remember, we don't recognize revenue or revenue if there's a dividend. We're only going to do it with a proportionate share of the net income. So we take our portion of this $32,000, and it comes down as $12,800 of investment revenue or revenue from investment in Tom's Surf Shop, however you want to put it. And then the corresponding debit, right? We've got a balance here. We've got to have a debit of $12,800. And what that debit is it goes to investment in Tom's Surf Shop. It's actually going to increase the carrying value. So if we were to look at this investment on the balance sheet, right? So we start out with $175,000. Well, now we've just debited it. So now it would be $175,000 plus $12,800. That's what the carrying value of this investment would be on the balance sheet. Now let's say that there's a dividend issued by Tom's Surf Shop. Now you might be thinking, hey, wait a minute. I thought you said that we don't recognize revenue from a dividend. Well, we don't. Under the equity method, we're not going to recognize revenue from this dividend. However, we are going to have a journal entry because remember, we're getting a portion of this dividend, right? We're getting 40%. We own 40% of the company. We're going to get 40% of this dividend. So we have to do some kind of entry. We're just not going to recognize revenue from it. So what we're going to do, 40% of 10,000 is 4,000, right? So the cash is the easy part, right? We know that we received a dividend. We received a cash dividend of $4,000, right? That's just 40% of the total dividend that Tom's Surf Shop issued. So we recognize that portion, but now we're not going to credit dividend revenue. So what we credit is actually investment in Tom's Surf Shop. A dividend will actually reduce the carrying value of our investment on our balance sheet, right? So we see here's that we started with $175,000, And then we increased the carrying value when we had some revenue, and then now we decrease it, the carrying value, with a dividend. But we don't recognize any income here, right? It's different from the fair value method in that respect. So if we were to think about our carrying value at this point, our carrying value, and by carrying value, I just mean if we were to look at the balance sheet, what is investment in Tom's Surf Shop? What does that show? We have that $175,000 that we originally paid, plus the $12,800 that proportionate share of their net income, and then minus the dividend of $4,000. So it would be $183,800 is the carrying value of the investment in Tom's Surf Shop at the end of the period. Now note, there's something really important here that you need to understand. So unrealized gains or losses are not recognized under the equity method, right? Because we're not doing the whole fair value thing where we say, oh, we've got an unrealized gain and then so forth. We're not doing that. However, an investor, right? So like you, for example, you're investing in Tom's Surf Shop, you have the option to irrevocably elect to use the fair value method, right? And if you were to say, you know what, we're going to make an election to do the fair value method to account for our investment in Tom's Surf Shop, then you would basically account for it exactly the same as if it were trading securities when you own less than 20%. So remember we talked about in our video, when you say less than 20%, we use that fair value method, right, where we do have the unrealized holding gains and losses. And so you just account for it with like trading securities. So any unrealized holding gains and losses would go to the income statement.